Good morning. Welcome to IG's Early Morning Call. It's Tuesday, 13th of June. Let's take a look at the headlines as we see a continuation of the recent rally in equity markets and the Nikkei 225 overnight hitting a new, fresh 33-year high. And the market's continuing to rise in the 24-hour session today. And we see a continuation of the recent gains across the board for global indices, looking for a stronger start when things get underway on the European markets in half an hour's time. All this comes as we see a continuation of the move slightly lower for the US dollar. We've got the dollar down ahead of a number of features in the markets. Today we've got the CPI data. Of course, tomorrow we've got the big number out from the Fed on the economy, as well as the decision on interest rates. There's a lot of economic data due out tomorrow evening when the Fed makes that decision on US rates. Will be live on the IG platform. And the software company Oracle, smashing earnings estimates and beating forecasts, and the company seeing its shares rising, rocketing to a new all-time record high. The 78-year-old founder, chairman, chief technology officer, Larry Ellison, yesterday wowing Wall Street in the press conference, and the stock rising as a result. Let's take a look at what's happening in volatility. Interesting enough, volatility is up off the recent lows, despite the fact we've got money going into these equity markets today. And there's obviously a little bit of nervousness around the inflation data out later on today. I think widely expected to show that the Fed is going to continue to keep its foot on the pedal, which is not really what people want to hear. Is the US going to go into recession later on in the year? It does depend very much on how much further the Fed's got to go on interest rates. At the moment, London markets showing relatively strong gains, 76.04. And we've got this market now up for a second day in a row, looking for a stronger start when trade gets underway a little bit later on. But for me, the real runaway winner on the European equity markets at the moment, it's not a big winner, but it is nonetheless the best performing stock market. Yesterday, closing 24-hour markets pretty much the top of the candle, indicating a stronger start already to the trading day today. Then came the 24-hour markets opening earlier today on the German DAX, now at 16,198. And we are now trading at levels there not seen for 3 weeks. 23rd of May 2023 certainly seems like this is going to be the best performer that we've got in the European markets at this morning. Gains in the French markets as well, highs there not seen since the 29th of May. So you can see money going into equities, some money going into risk assets across the board. Overnight in Asia, in Japan, the Nikkei 225 rally taking it to a new 33-year high. We'll take a look at that in just a minute. Today, helped by SoftBank on the news, it made team up on an AI venture with OpenAI. Toyota also rising by nearly 5% in the session in today's trade. It's investing in a new battery for its electric vehicles, which seems to be one of the top news headlines on the Japanese equity markets in today's session. The Hang Seng, as you can see, with gains, Singapore Straits Times, no trade in Australia today. I want to show you the Nikkei 225 index. This is the very long-term chart. You can see the record high that we had all the way back in 1989 at 38,950. Then came the tumble. Remember, that was all about Nick Leeson. It was all about the markets having topped out. Leeson got all that wrong, of course, as history will tell us. And it was in a period of deflation. The Bloomberg report today really leading on this idea that inflation is beginning to take proper hold in the economy. Now, this is the first time in 3 decades that we've seen the inflation really begin to bite in the Japanese economy. Does this change things for the recent change for the makeup of the central bank? Could we see them move on Friday or when it meets to make an interest rate decision? 24-hour market showing us absolutely the top of the candle. There are no sellers in this market at the moment. 33,134 really is a stunning recovery back for the Nikkei 225. And if you've been able to ride this, what massive profits you're making on this market at the moment. Doesn't seem to be letting up either. Just quickly going back to the long-term chart, just to show you that there really is not an awful lot of resistance coming up. There is a spike there that we saw, which is pretty much just about where we are. In fact, just a little bit below where we are. So there's now not really much taking us out in terms of any of these highs that we saw back on the 1st of February, 1990, 1980, back into 1989. Not an awful lot really stopping us now before we get to 38,950 again. It could well take a while to get there if indeed we do in this particular run, but at the moment, at least technically, there doesn't seem to be anything getting in the way between where we are and that record high. Let's look at what we've got in terms of the US markets. NASDAQ close to a 40% rise now for the year to date. The NASDAQ composite up 1.53%. You've got to remember, though, that the breadth is really narrow in this. It's been taken up by the really big tech names. We've seen recently Apple rising, Alphabet, Microsoft. We've now got Oracle. I'll take a look at Oracle in just a few moments' time. But the bottom line is that we've got these companies, very few companies leading the NASDAQ up. But nonetheless, the NASDAQ itself is up 1.5% as of yesterday's close. S&P 500 also rising yesterday. Tech stocks leading the gains there. Dow Industrials also enjoying a little bit of a lift on the session yesterday. Let me take a look at what's happening with the 24-hour markets, first of all, on the S&P 500. Currently trading now at levels not seen since April 2022. This market continues to rise. Very strong day yesterday. Hardly any sellers at the close in the 24-hour markets late last night. Pushed higher by Oracle, and it got another rise there. But as I was saying about the NASDAQ is really where the key money's going. And in fact, we are very, very close now, just taking that up to the high point we got into the candle today at 14,875, up by a margin of 39.46% from the year to date. That is since the beginning of January, and we're now at levels there not seen since the 6th of April 2022. Intel said to be an anchor investor in the ARM IPO. That's a Bloomberg story. I'll see how that develops today. We might do a little bit of a video on Intel. I think it's worth looking at these chip makers which are doing such good business because of this move into AI. And chip makers on the whole making the most of the money. Yesterday, Intel climbing to closing levels not seen since the 29th of August last year. So Intel, big move up all sessions on the IG platform late last night. Let's take a look at some of the economic statistics out. Later on today, we get US CPI, which I'll take a look at in just a minute. But in Australia overnight, we've seen two surveys out overnight reflecting the RBA's tightening policy. Consumers are increasingly worried about the consequences of high interest rates and the worries that could have over employment prospects. Let's take a look at the Westpac-Melbourne Consumer Sentiment Index out overnight, remaining well below 100 in June at 79.2, suggesting pessimists greatly outnumber optimists. But what the survey also reveals is that the difference in readings before and after the RBA decision last week, before the 25 basis point hike, confidence survey was coming in at 89. After the decision, it dropped all the way down to a reading of 72.6. Now, the survey also showing that the unemployment expectations rising 6.6%. The other is the NAB business confidence, also showing worries around employment. This is Australia's business sentiment index, unexpectedly falling to a -4 in May, when the market expected the index to remain at flat. A negative number means that there were more pessimistic opinions than optimistic ones. The survey measures the sales overall, and that declined 8 points to a +14 in May. The employment index fell 7 to a +4. I want to quickly bring up a chart of what's happening with the Aussie dollar, although I think actually this market is really being twisted by what's happening with the US dollar falling. But you can see we're really on a rip here. And I wanted to highlight this as an interesting level to watch out for. 67.65 is where we're trading at the moment. Now, if you are in on this, obviously you'd be bringing your stop loss up. If you want to go long on this, there is a headwind above just where we are at 67.97. Let's call it 68 cents, which looks like it could well be the area to watch out for. Now, if you get a print above 68 cents, I'd then be happy going long on this again. On the Aussie against the US dollar. Despite the fact we've got some poor numbers coming out, I think it's all about interest rates. Clearly that the Australian Central Bank wants to continue to raise interest rates. We know the Fed wants to continue to raise rates, or certainly there could be the upward pressure being brought to bear on this. But that is a different situation where we could well see the Fed pausing tomorrow, but the Australian Central Bank looking as though it wants to continue. So MACD pointing up. indicators suggesting that we've got further upside to go here for the Aussie against the US dollar. One of the other things that affects what's happening in the Australian economy, what's going on in China. And the Chinese economy is showing all sorts of signs of slowing down, or rather not getting up in terms of the heat that many had been expecting at the beginning of this year. The central bank has lowered its short-term lending rate overnight. This is the 7-day reverse repo rate. It was cut by 10 basis points to 1.9%. Now, this indicates the central bank's concerns about the softness in the economy. The cut to the lending rate signals a possible easing for long-term rates. Let me just bring up a chart of the US dollar traded against the CNH, which is the offshore Chinese yuan. Now, bearing in mind, we've seen the dollar rising, but we've also got the CNH losing ground, and you can see this chart here only seems to be going in one direction. In today's session, we've seen the highest print for the US dollar at 71.652, the highest print we've seen there since November last year. The cut to the lending rate overnight from China signals a possible easing for longer-term rates. 1-year and 5-year loan prime rates used respectively to set consumer loan and mortgage rates could be lowered by the same margin next Tuesday, according to economists. They currently point to 3.65 and 4.3%. So that's something that could well be of interest. Now, the unemployment rate here in the UK, this is an unusual one. We had been expecting it to rise to 4%. The unemployment rate unexpectedly fell 1/10 of 1 percentage point in April, down to 3.8%. The number of people claiming for unemployment benefits fell by 13,600 in May. Now, that's going to be a little bit of a fillip to those talking about doom and gloom around in the UK economy. Take a quick look at what's happening with sterling, although this is going to be more interesting around today's CPI data, I suspect, in the States. This is sterling against the US dollar. We're currently trading 125.60. This is sterling up against that weaker US dollar, the weaker dollar coming in ahead of that CPI data out later on today. Before we take a look at euro-dollar trade, 10 a.m. this morning, German ZEW economic sentiment details are out. Economists anticipating the index to fall to a negative 12.7 in June from 10.7 in May. Remember, the German economy went into recession, a winter recession, between the fourth quarter of 2022 and the first quarter of 2023. Now, ahead of the US interest rate decision from the Federal Reserve on Wednesday on US rates, the market's preparing for the latest US inflation data due at 1:30 p.m. today, UK time. The consumer price index is expected to fall to 4.1% year on year, following a 4.9% rise in the previous month. Now, this would be the weakest CPI growth since March 2021. This is the headline rate. Now, more than the headline inflation rate, the focus will be on core CPI. This is excluding food and fuel. It's forecast to fall too, but not by as much, to 5.3% year on year from 5.5% in April, which represents an inversion of the two key measurements of consumer prices. Now, since March, the headline CPI figure points below that core CPI. With that really unusual inversion, energy prices have fallen substantially, but broad-based inflation seems to be stickier than thought. Quick update on where we are in terms of the US dollar basket. We're now trading pretty much close to levels not seen since the 23rd of May, so near 2-week lows for the dollar basket. An update on what's happening with euro-dollar trade. This bounce away from the 76.4% exacerbated today, highest print we've seen there since the 23rd of May. If you're long on the US data going into these numbers today, your stop goes underneath this 61.8% of retracement lines. You'll stop at around about the 107 level. If you're long at 107.95, which is where we're trading at the moment for the euro-dollar. Now, that takes us through all of what we've got in terms of the moves on the FX markets ahead of that data out later on today. Let's shift on now to take a look at what's happening with some of these companies worth watching out for. HSBC was down 1% in the Hong Kong markets today. This is where we are, and we're looking to open today here in the London markets at 6:04. A while back, we saw how HSBC decided to part with less profitable businesses around the globe. It certainly seems to be going well. We've seen this rise recently for HSBC stock. Earlier this morning, the bank announced it will close its New Zealand wealth and personal banking system interests, which will be another interesting move for HSB as it focuses on what it believes to be core businesses for the company. That stock will open at 604. Want to stay on the charts? Take a look at a couple of other companies worth looking at. Look at this big move that we've seen on Ashtead recently. Yesterday, closing at levels not seen there since the 13th of March. This is the construction and industrial rental business. Ashtead reporting higher revenue and profit this morning for the full year. Adjusted profit before tax coming in at $2.27 billion US dollars compared with 1.82 billion this time last year. Total revenue up 24% to 9.67 billion. This company is doing really good business in the States. The weakness in sterling to a degree helping some of the transitions, although they report in US dollars. But Ashtead could well be a potential upside stock to watch out for today. If you're long on this at 54.08, stock goes underneath the 54 level to watch out for there. And again, staying on the charts, because there's another company I want to point you in the direction of today. And this could well be something possibly of a negative swing this morning for Bellway, the house builder. Trading statement today. Overall, headline pricing has remained firm across the regions, according to the statement this morning, although targeted incentives continue to be used in certain parts of the country. Now, this company is using management speak, I think, to cloud what is otherwise an issue where these house builders have got a real problem on their hands. They've got rising building costs. They've got rising interest rates, which is a massive headwind to consumers. Consumers aren't prepared to pay the costs, the soaring costs of house building, and Bellway, amongst others, is indicating this in the numbers this morning. They have a lower forward order book with a value of just over 1.7 billion. This time last year, that was 2.4 billion pounds. In line with previous guidance, the group says it's on track to deliver full year volume output of around about 11,000 homes. That's down 200 year on year. But the problem is that I've got here with these house builders are average selling price is expected to be around 300,000. Now, I calculate that's something like around about 3.8% down on last year. Consumer price inflation is running at 10%. If you put 10% on the top of 3.8%, I know it's a little bit of a rough calculation. That's why you get big drop in house prices. House prices are down. We know that because of the Halifax and the nationwide. But when you weave in that total consumer price inflation rate that we've got, house prices are down substantially now from where they should be and where they were down this time last year compared to prices. And Bellway is finding it going tough because they can't hand on those higher building costs. It's not just bricks, it's not just tiles, it's not just copper, it's wages as well. It's the cost of employers, pardon me, having to deal with all this in the rising inflation environment. They just haven't got the pricing power. And I think potentially this sector could well be in for a bit of a downside. We've got another 100 basis points of interest rate rises coming through from the Bank of England. That's what economists are saying, possibly 125 basis points over the next year. And that is going to be a real problem for these house builders, whichever way you cut it. And I think that's what's been demonstrated this morning in these Bellway numbers. I urge you to take a look at the figures this morning and see what you think. But I'm going to go short on this stock at the start of today's trade. Insofar as what I would be doing, my price here is at 22.38. I'd put my stop loss above the 2300 level with a view to coming down to this 200-day moving average at just over £20 to share. That is my price target, and that's going to be my trade. I may get stopped out, but that's how I'm setting myself up for this morning's trade. I don't like the look of house builders where they are at the moment. I think they're overpriced given the outlook for what's happening. Oracle shares soaring to a record high last night after the company smashed earnings estimates and forecasts for the business. And the 78-year-old veteran founder, chairman and chief technology officer, Larry Ellison, who still owns 40% or so of the business, looking younger than ever, wowing Wall Street last night at the press conference. The software vendor announcing fiscal fourth quarter results that exceeded Wall Street's expectations. Adjusted earnings per share, $1.67 versus $1.58 expected, on a whopping 17% climb in revenues to $13.84 billion. Now, the company's top source of revenue, which is the cloud services and license support business, jumping 23% to $9.37 billion. Revenue from cloud infrastructure climbing an eye-watering 76%. It's only a small part of the business. It's $1.4 billion. But nonetheless, it is a big rise year on year. According to CNBC, it's expanding faster than rivals such as Microsoft and Google, despite being much smaller. Let's take a look at the chart, and you can see in one easy quick to understand move that we've got, this move up that we've seen all the way up to $120.70. During the quarter, Oracle said more of its cloud services had been approved by US defense and intelligence agencies, and that is an expanding sector. Excluding the after-hours move, Oracle shares have climbed almost 43% so far this year, while the S&P 500 index is up around about 13% over the same period. But whichever way you look at this, Oracle, an all-time record high last night, with one of the biggest upside candles we have seen in this stock in recent memories. And that was as a result of these earnings out last night from Oracle. It's one-way stock trading. It could be a bit of money taken off the table this morning at 9 o'clock, all sessions on the IG platform. But the broad sweep of things is it smashed earnings estimates last night, smashed forecasts, and Larry Ellison, one of the longest surviving Wall Street veterans, continues to make a ton of money out of Oracle. Let's move on, take a look at a couple of other areas. Just wanted to quickly talk about this this lower dollar that we've got in the market and the knock-on effects to that. Let me just quickly update you on what's going on with spot gold, which quite often moves in the opposite direction. That's exactly what's happening this morning. It's not a big move. It is up at 1962. But I think more importantly is what's happening with the price of oil. There is a little bit of an uplift in the session today, but I think broadly speaking, it wants to break, this is Brent, it wants to break this $70 line here. We're currently trading at 72.49. If you're short on this, stock goes up here at around about the $75 level if you're short on this in the longer term. As I say, it is up today, but I think the problem is that with interest rates rising, continuing to rise across the board for many central banks, renewed fears are potential drop in demand in the longer term. If it does drop below this $70 level here, then we'd be trading at levels not there seen since December 2021. That's it from me. Watch out for Bellway at the start of today's trade. Certainly one of the stocks I'm going to be on the back of this morning. Also at 9 o'clock this morning, watch out for the Oracle response, all sessions on the IG platform. We had that response last night already built in. Said we might see a little bit of money taken off the table at 9 o'clock this morning, UK time. All sessions on the IG platform we'll have to see. But Bellway, certainly a stock to watch to start. We're back at 10:30 with Charting the Market.